Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm going solo to talk about what it's like to buy a stock and hold it for 5 years. That's a really long time. Most investors don't even hold for 3 months. And even a year would seem like a really long time. But 5 years, that's really, really long. And what does it take? Why would you want to do it? Well, years ago, Warren Buffett often said that you should be able to go to sleep, wake up years later, and not be concerned with what your company had done while you were, sleeping away, snoozing away all those years. So in his mind, you should be picking companies that have what it takes to survive another 5 years and to grow both earnings and revenue during that time. And this may seem obvious, right? I'm sure you're sitting there thinking, well, why not just buy the Mag 7? Why not just buy some big cap, well-known name brand company because it's been around this long? Why wouldn't it survive another 5 years? Why wouldn't it continue to do well? But history has shown us it's not really that easy. And even some big name, really well-known old companies go through periods where they struggle and the shares go basically nowhere or even down during that time period. So I want to talk about a few of those types of stocks to begin with. And then I'm going to talk about a couple of big cap names that you may want to look at to consider if you are thinking about buying and holding for 5 years. So one of the big cap names that everybody loves right now, and they have for years, is Costco. I'm bringing up the chart of the 5-year chart for Costco, and anyone who has owned it during this time period knows it's basically making new all-time highs right now in 2024. And you can see on this chart that it is up 216% during that time period. And this is going back now just before the pandemic into 2019. But we're about to get close to where the pandemic actually began in the 5-year chart. But this one prior to the pandemic and then now afterwards, obviously. Now, I compared it to the S&P 500 using the VOO, the Vanguard S&P 500 ETF. And then I wanted to take a look at a couple other big name stocks that in 2019 you might have thought, hey, I'm going to buy this. It's cheap here. It's got a good business. It is been around for seemingly forever, at least a couple of decades. And now we know, looking back, what has resulted from the stock itself over that time period. And the two stocks I chose, one of which I actually own, is Starbucks, ticker SBUX, and then Intel, ticker INTC. And while both of these companies had their ups and downs last decade, I don't think anyone would have foreseen the actual ups and downs that were to come over the next 5 years. Starbucks dominates its market and continues to dominate its market in the coffee area, but just in fast food in general. It continues to open up stores worldwide, and it's seen good comparable same-store sales over this last 5-year period, especially once the pandemic started to recede and the stores reopened on the interiors and not just like through drive-throughs. And they could get back to the basics of the business, which is, just going inside the store and selling the coffee. And Intel was one of the top chip companies in 2019, but and it was struggling too because it wasn't able to make as good of transition into smartphones like some of its competitors did. So it was falling behind there, but I don't think anyone could have foreseen this AI revolution and Intel falling even further behind due to that aspect. So you can see on the chart, Starbucks over the last 5 years is up only 7.3%. And then the VOO up 94. Costco again is up 216. And then Intel, even worse, it's actually down on the 5-year stack, down 54.6%. This is why long-term investing is really challenging. And people like Buffett make it seem so easy, right? Oh, you just buy and hold some big name company and you outperform, you do really well. But this is just two names that have not outperformed. And as a long-term shareholder of Starbucks, I bought back in 2014. So it's been 10 years for me. This is, difficult to stay in a stock like this once you have been buying and holding for 10 years. Now, thankfully, some of these companies do pay a dividend, but the dividend can also be a trap to kind of keep you as an investor around while you're getting something right for your patients. You're getting that 2%, 3%, 4%, or maybe even 5% during that time period. But it doesn't make up for the underperformance because the S&P 500 pays a dividend yield too. And it may be low. It may only be under 2%, but you're getting 94% return over that 5-year time period. So this is just something to keep in mind as we go forward through this podcast and trying to determine what stocks can we pick for the next 5 years. There are no guarantees, as I said, and sometimes you're going to get a winner like a Costco, and sometimes you are not. But let's stay on Costco for a minute. And I'm going to get off of this chart now and just go look at its normal quote page. Costco's about to report earnings here at the end of September 2024. So we're waiting on that. It's a Zacks number 3 right now. It has a very good style score still, a B for value. That's kind of shocking to see a B for value because Costco's trading with a forward PE of 52. So 52 times, but it's got the B for value, but there's other components in value. There's price to sales, price to book, price to free cash flow, various other things, pegs that it could be looking at. So B is a high score. A is the highest, but B is second highest. So that's high. We do get a B for growth. And it does have that. And it's got A for momentum. So it's got an overall sales score of VGM. Score of A. So that's the highest. But again, scrolling down, you can see forward PE of 52. Now, a lot of people have owned Costco over the years for the long haul because there is kind of a cult around Costco, which is what you need to have off of a good retail brand. So the customers are kind of in the cult because they've been customers for years, but the shareholders are also in the similar situation because of the 216% 5-year share growth, right? And then you can see you also do get a dividend with Costco. It's only paying a yield of 0.5%, but that yield at least is something, right? And a little bit of addition while you're also buying the stock for the stock appreciation. But let's take a look at those detailed earnings estimates going into this earnings report. We actually know a little bit more about Costco and its earnings because they still give monthly comparable sales. They're one of the few big retailers to give the monthly numbers. All of the retailers used to do it back in the day, a while ago. So I'm dating myself a bit, but Costco's one of the few that still gives the monthlies. So we know that the monthly comparable sales, which is the same store year over year for that month, are still really strong. They're not even in the low single digits. They're, above 5% on the same store sales growth. And that is amazing because it was strong last year as well. So they're literally doing over whatever they did last year again this year. So nobody counts out Costco. And that's why I would pick it as a stock to buy and hold for the next 5 years, even with this valuation, because the consumer is slowing, but apparently not at Costco. And their business is developed and situated so well that it may even do well during an actual recession, even though it will slow, but still. We have on the earnings expectations, I'm pulling that up, and this fiscal year still expected to be double digits, up 10%, and next year another 8.8%. And again, this is on already huge numbers. You can see revenue is in the single digits, 5% for this year, 7.3% for next year, but this is a more mature business. And, but it still has some areas to grow. Certain parts of the country might not have a Costco, and they are expanding internationally, opening up more places overseas. They already have been overseas for a while, but still spinning out some of those stores overseas. So that's always a risk. Just because a brand works in America and even America and Mexico doesn't mean it's going to work in Asia or Europe or anywhere else. So that is something to keep an eye on. But Costco, again, looking pretty good here on its earnings. Yes, you are paying up for those earnings, but I don't think Costco is going to go anywhere in the next 5 years. Hopefully management continues to perform as they are. I put up the price and consensus chart, and you can see it's just a very good chart straight across, nice earnings growth year over year over year. And the chart is reflecting that. Now, one thing to look at, though, is take a look at here in 2022 when a lot of the growth stocks sold off. You had a bit of a sell-off in Costco, and then it kind of rebounded, but it just kind of treaded water for about 18 months before taking off again. That's actually kind of a good sign you want to see with the stock if you're a long-term shareholder, because it was basically kind of consolidating in that range while the earnings continued to rise. What you don't want to see is consolidation, but the earnings are actually on the decline, because that means, the stock is actually getting more expensive. But here it was trying to catch up to its valuation, but now it's taken off again so quickly that it's stretched a little bit here on a PE basis, once again, with that PE of 52 times. But Costco, one of the top retailers, and I still do like it for a buy and hold for the longer haul for that 5-year period. So let's get out of retail and switch over to some healthcare. So healthcare is an interesting area to be in to buy and hold. You can get something that's really working, or you can get an area that's kind of just stagnant. So we're going to start on healthcare with one of the big drug companies. This has been a very difficult area to buy and hold over not even 5 years, but the last 25 years, because a lot of the big drug companies had some hot drugs that really spurred growth in the 1990s. And then they either went off patent or just kind of sales stagnated, and they didn't find any new growth areas really for about 25 years. There's been some growth, but not, these massive new types of drugs that everybody's been hoping and wishing for until now, until the weight loss drugs and some breakthroughs on Alzheimer's and even on cancer have really started to provide a catalyst to these companies on the drug side. And the one that we really want to look at is on the weight loss side. There's two big players in that area right now, Eli Lilly, ticker LLY, and Novo Nordisk, ticker NVO. I'm picking Eli Lilly. It's the US company. It's a little bit easier to get information on than Novo, but it's huge on the weight loss side, but it also does have this Alzheimer's catalyst that is moving forward as well. So I brought up just the quote page again on Eli Lilly. It is a number one, but remember that's a short-term recommendation. So that means earnings estimates are on the rise right now, but who knows in 5 years, right? This is interesting. I haven't seen a style score like this in a long time. So there's F's across the board. F for value, F for growth, F for momentum, F in the VGM. Wow, those are the lowest scores across the board on style scores, but it's got the top Zacks rank. It's a strong buy on the rank, which is short term, but style scores, those can change often too. I'm kind of surprised it's an F on the growth side. And even on momentum, although the momentum has stalled a bit here, which we're going to take a look at. But value, I'm not surprised. It has a forward P of 55, but look at this PEG ratio. It's just 2.8, and that's about half of what Costco's PEG ratio just was. And we were just looking at that one, and it has the higher value score. So the style scores are a mystery sometimes, right? That's why I do like to look at the VGM because it combines them all. But Costco had the A VGM, and now Eli Lilly has the F, the lowest. But let's look at the detailed estimates because maybe that'll give us some guide into at least why growth is the F, because I do consider Eli Lilly to be the growth stock. And, how does it get an F when it's supposed to see double-digit earnings growth because of everything that's going on with all of its drugs? And even triple digits. I just brought it up. So for 2024, earnings expected to be up 160% this year to 1649 from 632 last year. Wow. And then next year, 2397 up from the 1649. Another 45%. It's got double digits sales growth as well, 35% this year, 27% expected for next year. These are just some tremendous numbers. And as I said, it's got the Zacks number one rank. So yes, 11 estimates are up in the last 60 days for this year, 3 in the last 30, although 1 has been cut in the last 30. But next year, similar story, 9 or higher 60 days, 4 in the last 30 days. No one is cutting for next year. So these are real bullish for the next year. We're looking 5 years out. But when you have a new drug and you're introducing it globally, it takes a long time to roll it out globally. So just recently, Eli Lilly got its weight loss drug approved in China. That was just weeks ago. So it's going to take some time to roll out that drug in China. It's taking time to roll it out in other markets. And they're all in the race to try to find a pill version of these weight loss drugs as well. And maybe that'll be coming down the pipeline. We don't know in the 5-year stack, but with the drug companies, once they do get a drug approved and they are rolling it out, and it has the kind of demand that this one does have on the weight loss side and even on the Alzheimer's side, then this can build momentum for several years. So that's why I like the drug stocks if they have a drug that is this hot. Let's look at the price of consensus on Eli Lilly. You can see up and to the right, and even the analysts getting even more bullish on 2026, which wasn't even in on the detailed estimates. And so good things are being announced there still, and the analysts are still liking it, thinking they're behind. This is what I want to see on a buy and hold type stock over the next 5 years. Okay, so switching, but remaining in healthcare. So there's a lot of ways to play healthcare. There's the hospital side. There's even staffing. There are, companies that place nurses and doctors into jobs. And then there's medical products, or in this case, it's called medical instruments, but it could be one of the two. And in this case, I'm choosing Intuitive Surgical. I used to call this stock a beast, and now looking at it again, it's returned to its beast mode. Its ticker INTUS. S as in Sam, R, G as in George, ISRG. It was really on the radar before the pandemic. Shares got hit in the pandemic because what they make is something called the Da Vinci surgical system. And it's a computerized surgery, basically. It helps the doctors pinpoint with, computer accuracy during surgery. It is a big computerized system that they sell. And this has been around numerous years, the Da Vinci system, and they're still rolling it out around the world. So, as I mentioned with the drugs, it takes just as long to roll products out as well. Now, looking at Intuitive Surgical, it's a Zacks number 3, which is the hold, and it has a bad style score too. D for value, which I'm not surprised at because the shares have soared. C for growth, C for momentum, and a VGM score of D. Oh, I forgot to mention Eli Lilly, 5-year stack on Eli Lilly now is up 718%. And that compares to Costco up 215 or 16%, as we saw. So just keep that in mind as well. Intuitive Surgical, what's there? They're up 157%, but that is because the shares did get hammered in the start of the pandemic. Hospitals weren't buying the system because they were dealing with the pandemic. They had other things going on, but now they're buying it again. Earnings have rebounded and the stock has rebounded as well. And now it's on its way to new highs once again. Forward PE on this one is at 73. So not cheap. PEG of 4.2, no dividend. It's a pure growth play stock, but it's got C for growth, C for momentum, D for value, and the DVGM score. All of those are, subpar, but we're going to look at those detailed estimates because I still like it in the 5-year time period because everybody doesn't have the Da Vinci surgical system yet. It's still rolling out, as I mentioned, and look at the growth that's still expected. Earnings growth of 16.8% this year and another 14.8% next year. Look at revenue, up 13.7 this year and another 15.8 next year. This is not yet slowing. So we're still in, I would say, the mid innings. We're not at the beginning of the game. We're about in the middle of the game on the Da Vinci, rollout. And so things still look good. If you're in the middle, you're not at the end, and there really hasn't been any real competition. So that has helped tremendously. They are kind of in the game of their own. And let's look at the price and consensus because this will show more about what's going on, and you'll be able to see on the chart. So we had the dip and the pandemic, and then it slowly went to new highs. 2022, the growth stocks got hammered. It sold off. But it's been slowly grinding higher once again. It had a nice pullback in 2023 again, but then took off and now is at all-time highs once again. But look at the price to consensus up and to the right and look at 2026. Now, this is just what analysts are thinking is going to happen by 2026. That's still 2 more years down the road, but still showing up and to the right with substantial earnings growth for 2026 again. No guarantees that this will be the actual result. Nobody thought there would be a pandemic either in 2020 and that hospitals would be, pressured under such an event. But this is, on track for looking good for the next several years. And that's why I want to own companies that have this outlook of double-digit earnings growth. Now, this one is very expensive here at 73 times. It was very expensive back here in 2021 before it did see the big sell-off. So could we see a nice big pullback here again in Intuitive Surgical? Yes, most likely. So I might be on the sidelines here waiting for such an event. Because I am going to buy and hold and I want to get in at the best possible moment to, see the best possible outcome there. But it does have substantial growth and that's what you're buying. So this is Intuitive Surgical. If you want to stay in the medical area, ISRG is that ticker. And And that will conclude our medical side of things. I did want to go back to the consumer because a lot of people like to buy and hold the consumer names. It's a little bit easier to do than on the tech side of things because with technology, it can go out of date pretty quickly, even though, as we're seeing, Da Vinci Surgical Systems has not. But there's always someone who could make a new chip that's better than your chip, who can make a better operating system, who is going to earn more money off of online advertising than you are, who's going to invent a new social media site or product that's better than yours. So tech is a little iffy for the buy and hold, although you can have success in it. But I'm staying away a little bit from that. And I'm going to look at some other areas where you do have, if there's a ramp up going on, a longer term good times, let's say. So we already looked at Costco, and we all know that that has been expanding for a couple of decades now, but it takes a long time for the retail story to really unfold, especially now where you have global retail. So Peter Lynch, who was an top investor and manager of Fidelity's Magellan Mutual Fund in the 1980s and partially in the 1990s. He used to like retail stocks to buy and hold because he always said it took, a couple decades even to roll out that retailer nationwide. And that may seem kind of weird to think about, but even with a restaurant stock, it's the same kind of story. It can take decade or more just to have a restaurant in every US state. And the same is true with retail. So Costco has had a couple of decades to continue to roll out. But what about someone who is newer and maybe isn't in quite as many locations? That's the kind of stock I might want to buy and hold for the next 5 years. And the one I'm really thinking of is Builders First Source. And they have been around for a number of years, but only in recent years really ratcheting up the growth story with Builders First Source. So what is it? It is a store that is devoted to builders, and it's their first source, right? They go there. It's like a Home Depot, but it's not for you and I. It's not for do-it-yourselfers. It's for the professionals to go in and, be able to buy the products and the things that they need. So this has been in a growth story for a number of years. And now that housing has picked up and building in general has picked up, Builders First Source is really seeing strong growth in its earnings and its revenue. Now, since the Fed has raised interest rates and home building has actually slowed, Builders First Source has seen the slowing as well. So earnings have come down off of their pre-2022 highs, let's say. And 2022 is when the Fed started raising those rates. But the Fed is now cutting. So this should be good news for a company, a retailer like Builders First Source, or even like Home Depot and Lowe's. But I'm choosing Builders First Source because it's a little smaller and hasn't completely built out yet, and it's a little bit cheaper. So I'm on the quote page, and forward P is 16.7. It does have this really high peg here as the earnings have been cut. No dividend. Let's look at those detailed earnings estimates because that's going to tell us a little bit of the story. And what is it? It's a number 3 hold. Style scores are kind of mixed. It does have an A for value. I do own it in Zacks Value Investor Portfolio, and we've owned it for a while now, over a year. It has a D for growth and a D for momentum, but a B overall score. So not as bad as some of the other ones we've been looking at. But you can see the impact of the Fed rate hikes and what it's done on this year's earnings. So expected to fall 20%. So that's why I got the high peg. And next year, rebounding, expected to grow 9.2%. But look at the revenue. They have been struggling on that as the building has slowed. And so you're just buying less lumber, you're buying less windows, less everything by the builders. So this is down 1.6% for this year, but rebounding almost 4% for next year. So the growth isn't as double digity as some of these other stocks we were just looking at, but the stock is much cheaper. So I would like to get it a lot cheaper if I were buying in here, but the stock has gone up and down in the recent couple of years, as you might imagine. Let's look at the price to consensus on Builders First Source. And you can see it's been up for the most part during the pandemic years. And then it went sideways in 2022 when those earnings came down and when the Fed started aggressively raising rates. But everybody got kind of used to that, and the stock was deemed cheap in 2022, and the shares took off. They did pull back to end 2023, but took off again. We're not quite yet at the all-time highs, but the shares kind of want to go there, even though the earnings are looking a little bit depressed here, going the other way, not up and to the right like they were last year, but down. And so it's going to take some time for those rate cuts to work their way into these earnings estimates. And we have a little bit of earnings estimate for 2026, and it is much higher. As you can see, I'm trying to point to it with a little ticker. It's way up there above $17. And right now, the 2025 is looking at $13, and then we're little over 11 for 2024. So that's nice earnings growth if it happens, if we do see this turnaround. But this is the type of retailer I like. They are still in expansion mode, and now the Fed is actually on their side and not against them. Over the last 5 years, though, the stock has soared. It's up 846%. That's beating Eli Lilly over the last 5 years. They've got the weight loss drug. It's even beating them, and the stock is still cheap, but it has a little bit more issues than some of the others, and we'll see if it works through those issues over the next 5 years. So that's Builders First Source, ticker B as in boy, L as in Larry, D as in David, R. Okay, I want to cover just one more. And since we already talked about Starbucks, I would be remiss if I didn't talk about a stock that is in the restaurant area. But it's not the king of restaurants, which is Chipotle. That's the king. And it's not the prince. Let's call him the prince because he was the king, which is Domino's. Both of those have dominated over the last decade. This is a new upstart. They're growing quickly. The stock is not cheap by any means, and it's Wingstop. Ticker WING. There's probably a Wingstop near you somewhere. They are expanding internationally now, so the growth story is still there. And it's just been a phenomenal stock, and I do like it in the next couple of years going forward. Let's look at it on the quote page. Zacks rank is 3, so that's the hold. Style scores, F for value. I said it was very expensive, and it is, so you're not getting a value stock here. Growth is A, though. Momentum is A, and it has a B VGM score. So this one's living up to what the stock price is actually doing, which is still going higher. So forward PE now is at 113 times. The PEG, though, is at 4.2. That's cheaper than Costco's PEG. So that's not terrible, and much cheaper than what we just saw at Builders First Source, which was 11. So forward PE, not great. PEG ratio, not terrible. But not a value still, obviously. Dividend, they actually do pay one, yielding 0.25%. So very small, but you're getting something for being a shareholder. Dividend or detailed earnings. Let's look at that because this is going to tell the story. You are buying the growth. Earnings expected to be up 52% again this year to 378 from 248. And then another 22% next year to 461 from 378. And the thing about restaurant stocks is once they get the momentum as the brand ratchets up And it tends to keep that momentum, at least for a couple of years. Now, it will go in cycles. If it manages to survive 20, 30, 40, 50 years as a company, it'll have ups and downs. It'll have times where everybody says, you know what, their pizza just isn't very good. And then Domino's will roll out a brand new crust that actually was and is tasty. And then new customers, a whole new generation will find it. And then the stock will take off again. Same with McDonald's. It is, invented and showcased new products many times over the years. Remember when it went to coffee and drink specialties and everybody said, no, that's going to fail. Only Starbucks can do that. Well, it didn't. And it was another driver for the company going forward in those years. So there's always ups and downs. I want to get a restaurant chain when it's on the up and it's hot and the consumer is going there. I don't know about you, but I have gone to Wingstop recently, even just myself. Young people love it. College students love it. It is affordable and a lot of different selection on the products. So it's killing it right now. Let's look at the price and consensus. You can see from that how good it's doing on the earnings growth side. There you have it up and to the right, and big earnings growth expected for 2026 on this chart. Shares are at or near new all-time highs. And over the 5-year stack for Wingstop, it's up 394%. It got really red hot just in the last 2 years. So that's where a vast majority of the gains have been. Is it too red hot? Maybe, and maybe it's like Intuitive Surgical where it will have a pullback at some point here, and then maybe that'll be a buying opportunity. But for buying and holding for the next 5 years, if I'm buying a restaurant stock, I don't want one that's in, quote, a turnaround. I want one that's in this expansion mode where the brand is picking up brand recognition, and even market share over competitors. And people have otherwise just an optimism and good thoughts about a certain brand. And for now, Wingstop has that. Of course, 5 years is a long time. A lot of things can happen. Changes in management, pandemics, who knows what else? There could be bigger bird flu and the price of wings skyrockets. We've already seen that several times, but these are always risk factors when you buy and hold any company over the course of 5 years. That's why Warren Buffett always says, choose companies that have solid fundamentals, that have the growth story already intact, that have a management, that they know what they're doing and that you want to support and want to own. So if you went to sleep right now and didn't wake up for 5 years, you wouldn't be shocked at where the company is and what they've done over that 5-year period. Another thing you might want to look out for when you're choosing a stock is a company that has a strategy in place. Sometimes it'll be a 3-year strategy. 5 years is a little more difficult for most companies to look that far into the future. But companies, especially in restaurant side or retail side, which literally put into the public, this is what we plan to do over the next 3 years. Those types of companies, to have that goal and to put it out there into the world, usually helps companies to at least go towards that goal, even if they don't quite get there. But in my experience, a lot of those companies putting out those kind of projections actually do get there. And that's what I want to own if I'm buying and holding for the next 5 years. There's a lot of other companies I could have covered today, but some of these I knew had strong charts. There's really no way to screen for a stock you should buy and hold for the next 5 years. A lot of it is simply luck. So, be diverse. Don't just buy one stock to buy and hold for 5 years, because that's really going to have to be like a lottery type of stock where you just get lucky and you win there. But as Warren Buffett has shown, it only takes one big winner stock where you buy it and hold it for 5 years to make or break your portfolio. His in recent years has been Apple, but he has several others in his portfolio, which have also been huge outperformers, including Visa and MasterCard. So it can be done, the buy and hold technique, but make sure you do research and check out these charts and think longer term instead of the short term. Okay, let me recap the stock tickers I talked about. So on the bad news side, there was Starbucks, ticker SBUX, but maybe and hopefully the next 5 years is better than the last 5. Then we had Intel, INTC. It's been struggling. There's been talk of maybe acquisitions by Qualcomm on Intel. So we'll see what happens with that. It might not even be around in the next 5 years. Then we had Costco, ticker COST, Intuitive Surgical, ISRG, Eli Lilly, LLY, and also Builders First Source on the retail side, ticker BLDR. And then we finished it up with the restaurant, Wingstop, ticker WING. That's an easy one. Just Wing, WING. And as always, be sure to get all of our podcasts here. And I hope you watched last week's on AI stocks. You can go watch it on YouTube at Zacks.com/YouTube. Subscribe to our YouTube channel to get all of our podcasts on the videos so you can see all of the charts and our lovely faces on each of these videos. Or you can just listen in, and you can get us on Apple. We're on Spotify. We're on Amazon Music and SoundCloud. Anywhere you can get podcasts, you can find us. But be sure to do so. And I'll be back next week with a special episode with an outside guest for the first time ever, talking about insider trading and reviewing his great book on event investing. So be sure to join us. I'll see you again next week with some more stocks.